Welcome back, metric learners. This is our first lesson from chapter 1. Previously, we did a video on the overview of the chapter. You know what you expect to get from this chapter, which is chapter 1 in your lesson plan, in your grade 12 lesson plan. So this is our first lesson. In this lesson, we're going to learn about the basic accounting concepts, the definitions of accounting concepts. And what I want you to learn is that you should not cram these concepts. You should not cram the definitions, because in an exam situation or a test situation, you are not going to be given the exact definition that you've seen in the textbook. They can bring a scenario and say, for example, an asset was recorded at 100,000 rands, which is the purchase price, instead of 150,000, which is its fair value amount. So you should know which concept applies in that transaction or in that situation. So you see, it is not a definition. So you should know that this is about the historical cost concept. Yes, so we're going to go through the concepts or the terms, and you are going to learn how to know them by heart, not to cram them. So let's start with the first one. So each concept also has a definition and an example, and sometimes I would indicate what type of an account it is, if it is an account, what type of an account it is, so that you may know whether it falls under income statement or balance sheet. Yes, so let's start with the first one. The first one is accrued expense. What is an accrued expense? And the other name for an accrued expense is an expense payable. So you can tell that this is something that is due. It has to be paid. So by that you can also tell that it must be a liability. So there are things that will become obvious when you just reading the name of the concept. So the definition of it is that these are expenses that the business still owes at the end of the financial year. So the financial year has ended, say it's February, but there are expenses that have not yet been paid. So those expenses are called accrued expenses. They don't fall under the income statement, but the balance sheet, because they are liabilities. And here is an example. Imagine you are renting a building for your business, and you have used the building for December, but haven't yet paid the rent yet. That's an accrued expense. So it becomes a liability. It appears on your balance sheet. So you'll see, even when we progress with our lessons, that accrued expenses are shown on the balance sheet and not on the income statement. Yeah. So let's move on to the next concept. The next term or the next concept is accrued income. So another name, we also should know the other names for these concepts, because if they do not say accrued income, then they say income receivable, you should know that this is synonymous to accrued income. So what is it? Is an income that the business has earned but has not yet received. So here someone is owing us. It's unlike an expense wherein we are owing somebody. Now it is someone outside of our business who is owing us. So this is the income that we have earned but have not received yet. So it's like we've done a job, but the customer hasn't paid us, so it is an accrued income. And the type of an account is that it is an asset, because someone has our money, and cash is an asset. Yes, and then let's move on. Let's move to the next concept, an asset. This is not an account, it's an element in accounting. You remember the assets equals to owners equity plus liabilities, the accounting equation. Yeah, those we call them elements. This is not an account. There are accounts that fall under it. So what this one means is that these are the things that the business owns. These are the things that the business owns. So things such as vehicles, the cash in the bank, the equipment, including debtors, money that are held by debtors. They are our assets. And then the next concept is bad debts. Bad debts is money that we are owed, but we will not be able to get back. So it's like we have given up to say that this person is not gonna pay us back this money. So we classify that amount as bad debt, and it is an expense. It's an expense because it's a loss. It's a loss in revenue. So you'll find this in your income statement because it's an expense. Remember that your income statement comprises of income and expenses only. So any account which is an income or an expense falls under the income statement. And then let's move on to cost of sales. Cost of sales is an expense, and it is defined as the cost of goods, or of the cost of selling a product. For example, if you buy something for 20 rands and you sell it for 30 rands, then the cost of that item was 20 rand. So it costed you 20 rands to make 30 rands. Yes, and you know where it falls in the income statement. At the top there, the top of the income statement. And then we have creditors. Creditors are the people or companies who owes us money, to whom we owe money. Yes, so these are the people that we buy from on credit, so we owe them money. These ones we owe them money. So anytime a business makes a purchase on credit, then that person, we call them a creditor, and it's a liability account on the financial statements, which means that it falls under the balance sheet. And then we have debtors. Debtors are the people that owe us money. These ones who us money, they have debt with us. For example, if a customer comes to our store and buy a phone on credit, not on cash, then they become our debtor. They're indebted to us. And the type of an account is that they are an asset. They are our asset. It's like we own them. Yeah, you can't own a person, but somehow you own them because they owe you something. Yes, you owe that money that they have. And then the next concept is depreciation. This is the loss of value in assets over time. It is not something that we pay in money, but just a loss of value in an asset. For example, assets such as vehicles lose value over time. So when an item becomes old, it loses value, and that value that it loses, we call it depreciation. So this is an expense account and is found on the income statement. We should find this item on your income statement, not on your balance sheet. And then the next concept is the income received in advance, otherwise known as deferred income. So an income received in advance, you should know this term. In advance means it's like saying for the future. So it is money received now for work or services to be done later. So this person is paid for their services in advance. They just felt that, okay, I have money right now, let me pay for this service, and then the company will provide the service later. Yeah. So yes, that is it. And then it's a liability account. Why is it a liability account? Because if the customer comes back and say, no, I no longer need the service, let's cancel the contract, then you'll have to refund them. So that money sitting in the company's bank account is actually a liability. We don't own it 100%. We own only the portion that we have delivered the service for. So if we have delivered the service, then we'll own the money. But until we have without delivering the service, we will not own that money. So it becomes a liability, and it will go to the balance sheet. It will be shown on the balance sheet. And then a liability is also an element like an asset. It is not an account. It's an element in the accounting equation, to be precise. So these are the monies that the business owes to others. So things such as loans, unpaid bills, yes, they are liabilities. So we owe someone this money. They are liabilities. Just like this one, income received in advance. It's a liability. It falls under liabilities because we owe someone money. And then a loss. A loss is a general term, which means that anything that you lose is actually an expense. Anything that you lose. When a business spends more money than it earns. Okay, this one refers to a loss that you make when trading, but it could also mean lose. You'll actually see this when we do there's a concept of trading stock deficit, which is a loss. But in this case, it refers to a loss in terms of profit and loss, not that you have lost something. And then we have markup. Markup is the percentage that you add to the cost price to get the selling price. So you have the cost price, you buy something for 50 rands, you add 50% markup, and then that thing becomes 75 rands, which is the selling price. So what you have added is the markup. You might even say, okay, I have this thing I have bought something for 100 rands and I want to sell it for 150. Without applying a markup percentage, we can calculate the markup percentage. We can calculate how much markup percentage you've added by you just adding the amounts. So I mean, in real life, that is what people do. They don't go with the markup percentage to simplify their lives. And then we have owner's equity. So owner's equity is the value of the business after subtracting liabilities from assets. So if we look at the business balance sheet and say assets minus liabilities, we get the value of the business, which we call owner's equity. And then we have another concept, prepaid expenses. Remember up there we had accrued expenses. Now we have prepaid expenses. So a prepaid expense is an expense that we as the business have paid for in advance. We've paid for in advance. For example, let's say that our financial year ends in December. Our business financial year ends in December. And in that month of December, we pay for insurance for 12 months. That means that we have paid for December and then January of next year, February up until November. So the extra 11 months that we've paid for, that money is called a prepaid expense. And it is an asset because what? We can claim it back. If we cancel a contract with this insurance company, then they will have to refund us. So it is our asset. And then we have the concept of profit. So profit is when you have made more money than you have spent in the business. So you have profited. It is the opposite of a loss. And then we have trading stock deficit. Trading stock deficit is when counting the amount of stock in the warehouse, the physical stock, you find that it is less than the stock in the books. What that means is that you go to the warehouse and say, okay, I have 50 boxes of, let's say, polish. I have 50 boxes of polish. But according to and say that those 50 boxes are worth 50,000. But when you go to the books where you record your stock, you find that no, I'm doing the opposite. I almost calculated trading stock surplus. So you go to the books show that you have 50 units. You have 50 boxes of polish and they are worth 50,000, let's say. And then, but when you go to the storeroom to count the boxes, you find that there are only 45 boxes and they are worth, say, 45,000. So there is a loss here, as you can tell, because what the books say should correspond with what is in the warehouse. But when you find that in the warehouse there is a shortage, then there is a stock deficit or stock loss. And this is an expense account. You're going to show this on your income statement. And then the last concept is trading stock surplus. So trading stock surplus is the opposite of trading stock deficit. With this one, it means that the books would say you have 30 units, but in the storeroom when you go to count, you find that there are 35. Yeah, there are reasons why these things could happen. And it's logical. If maybe you are asked a question, what could be the reason for this, you could say that the person who records stock might have forgotten to record the new stock bought. That could be the reason, because how come the books show a low amount of stock, whereas in the warehouse there is more? So they might have forgotten to record this, but we classify that as an income. Yes, so that is the end of our first lesson. Let's meet in our next lesson. The next lesson is about the rules of debit and credit. So we're going to learn of these accounts. When do you debit it and when do you credit it? Any accounting, because there are a lot. There are a lot of accounts in accounting, so you should know when to debit, when to credit an account. Let's meet in the next lesson. Thank you.